This is Chad Toyne with a Thursday, September 4 Market Minute from Trader PhD Ag Marketing. In the grains, corn had a modest pullback yesterday after a big three-day surge that gained a total of 17 cents. Even though yesterday's pullback felt sizable, losing about 5 cents, it failed to post a new low, lower than the day before. And that's why today's lower low, posted this morning, is more meaningful of a pullback. But the corn market is doing it again. After the December being down 4 cents, we are back up into the green by a couple of cents. That posts another nice intraday reversal higher. What's all that mean? We are continuing to see the price action show a firm tone in corn. In soybeans, they have been showing the same nice firm tone, but the pullback that we had yesterday and then further losses this morning took the air out of the tire. But beans have a nice intraday reversal higher here as well today, so I wouldn't count soybeans out quite yet. Yesterday, no-V beans lost 8 cents, and here this morning we saw losses of another 10 cents. But now we've rallied back 12 cents up off of the low. This dip in beans represents a test to the lower end of the trading range with support at no-V 1027. Prices plunging past 1022 and now trading above support here by the close. We want to continue to see beans hold a close above no-V 1027 to stay positive here for the short term. So what's got soybeans down here lately? It wasn't the crop condition ratings. Those were bullish. Bean ratings fell from 69 to 65% good to excellent. That's a drop of 4 points. By the way, the corn ratings fell as well, dropping from 71 to 69% good to excellent. That's a drop of 2 points. Maybe it's the rains in the forecast that's due to fall in the dry parts of the eastern and southern corn belt. Rain might be too late for much of the crop, but it might help late planted crops. Really, I think beans got mostly hit from the China trade talk fatigue. China met with other world leaders in a summit recently, including Russia, India, and North Korea, and the optics that we got was more of a how do we gang up against the United States rather than anything positive for the grain markets. We're keeping an eye on bean oil. Beans are likely to get their biggest boost from some kind of bullish surprise in the bean oil side of things. Bean oil is at a support level at the moment, and they've tested their support just like soybeans themselves did. In wheat, the KC contract continues to be the weakest link. We posted new lows here today. Now we have Chicago wheat, and that's been holding their own lately, but they reached down and posted a new low as well. It's said that HRW wheat here in the United States is the highest price in the world on an FOB basis. Wheat prices here in the U.S. could continue to face pressure if the European and Black Sea prices move lower. When pricing opportunities are rare, risk management and hedging is gold. Give us a call and ask about what our new commodity brokerage service, Trader PhD Futures, can do for you so you can protect yourself. Or at least inquire about a consultation with our own Nick Lawrence. Reply with a text and we can reach out to you. In cotton, the chart is looking pretty sick. A droopy formation, especially in the December, is threatening another leg lower. This sideways trading range doesn't look like it's going to hold. Downside risk is relatively limited though. Contract lows is $2 lower. Fats and feeders. We are seeing some relatively modest pullback action here lately. The manner in which this price action has happened is not very threatening. It's not acting like it's putting at a top. We could see prices meander a bit for the next week or so, but we'll keep an eye on it and let you know if anything dangerous looking pops up. And in hogs, we put in new contract highs on Tuesday in the December, a pullback day yesterday, and mostly sideways here today. I'm watching the volatility. Like cattle, the price action I'm seeing isn't usually what you see when a market is making a top. It's still nice and quiet, so there just might be more fun to come. But watch for cattle to lead the way. And what else is interesting out there in the markets? Gold has had quite the surge this past week and a half. The rally started on August 22 when Fed Chair Powell made a speech at the Jackson Hole Economic Symposium in Wyoming, hinting that interest rate cuts could come as early as September. Why did this move gold higher? 2 reasons. One is that it's a flight to quality, with gold being a safe haven, and the second is that lower interest rates increases gold's appeal as an investment, as a non-yielding asset, by reducing the opportunity cost of holding it compared to interest rate-bearing alternatives like bonds. Gold surged $250 an ounce, pushing it to an all-time high of over $3,600 an ounce. Gold is taking its first day of a breather since Powell's speech here today. That's it for today. I'm Chad Toyne, and this has been Trader PhD. Past performance is not indicative of future results. Futures trading involves substantial risk and is not suitable for all investors.